Welcome to our final presentation on bonds. And hopefully you'll find that this one is not as boring as is typical of bonds. Because today we're going to discuss yield spreads and their importance and what they can tell us about the future direction of the economy. And bond valuation, bond pricing. Something is going to look very familiar. Let's start on slide number 20, yield spreads. The spreads are the differences in interest rates that exist among various sectors of the bond market. In general, the shorter the maturity, the lower the rate. The longer the maturity, the higher the rate. Well, this makes sense, folks. Very, very simple. If you're going to lend money out for 1 or 2 years, as opposed to lending money out for 20 or 30 years, there's a whole lot more that can go wrong in 20 or 30 years than 1 or 2 years. So investors are going to want to demand a higher interest rate for the length of maturity. Plus, the higher the rating of the bond, the lower the interest rate, of course. A good credit risk is going to be able to demand a lower interest rate. A higher credit risk, a lower rating, well, they're going to have to pay more. And that's just true of individuals who have low credit scores as well. Right. Treasuries carry the lowest rate. The United States government, I don't care what anybody says, the U.S. government ain't going bankrupt. Municipal bonds are next, with general obligation bonds generally having more sway than revenue bonds, depending on the project that the revenue is generated from. And then corporate bonds yielding the highest rates. Why? Because they can go bankrupt a whole lot easier. Non-callable, giving you higher rates than callable. So, let's now take a look at slide number 21 and recent yield spreads. So, I'm not sure if you're going to be able to see this on a small screen, but interest rates have gone up since the last year, folks. They were a lot lower a year ago, especially on the lower end. Look, 3 month, 0.75%. I mean, last year they were hardly anything. And you go up to the 30-year Treasury bond, still only paying 3. That's gone up a little bit, but not much. The 10-year's gone up a whole lot more than it was just a year ago. But the 30-year it's a little more higher. But think about it, folks. You're going to lock in your money at 3% for 30 years? Not this boy. I'm not going to do it. And then corporates, of course, are going to be higher. And, of course, we see that. The 10-year for the corporate, the A-rated, is 3%, a little over 3%. Twice. Not twice. I'm sorry. No, it's not twice. It's about, it's actually not that big a spread, is it? Because the 10-year Treasury bond is paying 2.3%. And the 10-year A bonds are paying 3.2%. So it's not, the spreads are fairly tight. 20-year paying 4%. So it used to be that Yahoo had some great graphs, great tables, but they're all gone. And now I got this from a company called GMS Group, which I guess is a company that sells bonds and services clients. So if you can find a better place, folks, please, because I'm a bit of a loss these days with Yahoo being destroyed. Slide number 22. Often investors will speak about the bond spreads as being tight or wide. Now, what does that mean? Well, I made mention on the previous slide, didn't I? A tight spread means the interest rates among the bonds they are evaluating are very close to one another. Let's say you had a Treasury paying 4.8%. Corporate bond paying 5.1%. That's a fairly tight spread. In fact, you'll hear in the industry that's 300 basis points. Huh? It's 0.3%. No, not 300. 30 basis points. Right, 0.01%. So 300 basis points is 3%. So a basis point is 0.01%. And I don't know why they do that, but they do this to sound like they're really important. So this is only 30 basis points. That's very tight. The wide spread means there's a big difference between the bond interest rates. the Treasury's paying 3.2%, corporate bond paying 8.2%. That's a, what, 5%? 500 basis points, if you want to sound really hoity-toity. Yeah, that's a big spread. For several years, bond yield spreads were very tight throughout the 2000s. During the turmoil of 2008 and 9, the yield spreads widened to levels not seen since the Great Depression, and they have narrowed significantly over the past few years. And in the previous slide, we saw that what the 10-year was paying 2.3 or so, and the 10-year Treasury and the 10-year corporate A bonds were paying 3.2. So that's fairly close. That's fairly close. What is that? 80 or 90 basis points? Yes, less than 1%. So they're very close now, the yield spreads. Here is the effect of inflation on bond rates. Inflation is the bondholder's worst nightmare. Well, I guess default is even worse, but you're diversified, hopefully. So, well, yeah, bondholders tend to be very, very wealthy. If you own individual bonds, not everybody, but hopefully they're well diversified. But inflation destroys all bonds, all bond investments. And so what you see is in the early 1960s, inflation was running very low, as it is now, and bond yields are about 4%. And then with inflation starting to tick up in the 70s, you see bond yields starting to spike until finally, early 1980, it started in 79 or so when the Federal Reserve Bank under Paul Volcker, who's still around, by the way, he was working in the Obama administration, tightened short-term interest rates, and then long-term interest rates followed suit, and they broke the back of inflation. And you see inflation just plummeting. That's the red line. And it took a while for the bond rates to come down, but now we're back to basically where we were, back in 1960. Bond yields are a little bit above 2%, and inflation is a little bit above 2%. Yeah, so that's usually a pretty good sign for things going forward, but we don't know. Many people are worried about bond prices, interest rates going up, and of course bond prices going down. We made that distinction over and over again, and they've been worried about it for years. But you go back and you look at some of the statistics from after the Great Depression, and bond yields were low for 20, 30 years. So there are significant periods of time where bonds stay low, bond yields, and of course prices stay high. But yours truly is not a big fan of bonds right now, whereas I really should be at my age. I should be more heavily invested in bonds. We have a little bit, but especially if you're young folks, I'm not a big fan of bonds. I tell people, you're 20s and 30s, you don't need bonds. And you're going to hear other people say otherwise. You're going to say, no, you should always have some bonds. And I understand why they're worried about people panicking when the market falls south. But you're the experts, and you're not going to do that. Slide 24, the yield curve. This is a curve that represents the relationship between a bond's maturity and its yield at a given point in time. And we also use it to make comparison among different types of bonds. Normally, during most of the time in our economy, the yield curve is upward sloping, which is a fancy way of saying that longer-term bonds have higher interest rates than shorter-term bonds. But sometimes the yield curve is downward sloping. We call that an inverted yield curve, where shorter-term bonds and bills, bonds that are about ready to mature, to become short-term bonds, and of course treasury bills and corporate paper and the like, they have higher interest rates than longer-term bonds. That doesn't make any sense. Let's take a look at a typical upward sloping curve. This is what is typical. This is what we see now. Shorter-term maturities have lower interest, lower yields, lower interest rates. And as you go up the yield curve, you pay more and you go out further and further in time. but sometimes it's inverted, the downward sloping curve. Very rarely, and we will discuss why and what the ramifications are in just a bit. But before we do that, let's take a look at the current yield curve. Now, this is not the best. I don't think Morningstar's is the best. I've seen others that were better. Of course, Yahoo had the best, but they destroyed it. And it's more, this is more showing you this sort of sloping this way, but it usually slopes the other way. It usually has a more of a this is, I don't know what you say, concave. It's usually more convex, which like the one on the previous slide. But if you go out and find a better one, please tell me. New York Times actually had a pretty good one. I was going to steal that one, but I don't know. They get pretty angry when you steal stuff from the New York Times, so I don't want to do that. So, well, but what is this showing us? Here, the green is now. This was April 12th, 2017. And you see that 3 months are paying 0.75, remember? And then we go up, this is the Treasury, by the way, the Treasury bonds, Treasury bills and bonds. And we go up to 3% for 30-year bonds. Ooh. Well, just last year, the 3 month was paying almost nothing, 0.05 or something like that. And then it sloped up to 2.3 or so, 2.4 for, wow, 30-year bond, you're going to get 2.4%. Well, that was last year. And so they're showing you last year's. And you see interest rates are on the rise. And bond investors, some of them are freaking out. Because when interest rates rise, what happens to bond prices? Yes, they go down. But we're going to mention this in a little bit. I'll mention it once now, and we'll come back to it again in this presentation, because it's really something that bond investors right now should hang on to, because a lot of them are frightened. And I don't blame them. I mean, when interest rates rise, bond prices go down. But economists have been predicting interest rates to rise for years since the Great Recession, and so far they've been wrong, and someday they'll be right. They're starting to rise a little bit now, a little bit. And there was a bit of a bump last year after the election. They called it the Trump thump. And then the stock market had the Trump bump. And now why do these people? This is how they earn their money. It drives me nuts. But the Federal Reserve Bank is starting to raise interest rates because they believe the economy is a lot stronger. Dear students, if they are correct, which no, they're not always correct, folks. It's not an easy job. I'll be the first to admit it, that it's not an easy job for them. People will get very angry at the Fed, but I'll say, you do it. You do a better job. See how well you do. And if they are correct, this is a very good sign for the economy. It's a great sign for stock market, great sign for people's wealth, for earnings, for companies, and for salaries. It's a great sign. If it's happening, and we'll see. And they might be a little bit premature. We don't know. And some people say, well, they waited too long, and I don't know that if that's true, then we should see inflation a whole lot worse than we do, and we don't. So it's a difficult thing to do. But as interest rates rise, bond investors, as long as they take a long-term perspective, have to realize that that's good. In the short term, yeah, you're going to lose some principal, but new bonds are going to be paying more. And over the long term, what do we get from bonds? Typically interest. That's the long term. Okay, so we see the yield curve now, and we see that it's upward sloping. Now, on slide 27, we take a look at some of the theories. Why is this so? Why do longer-term debt securities normally have higher interest rates than shorter-term debt securities? Well, there are 3 hypotheses, apart from the fact that it just makes perfect sense that, yes, the longer you have the money out, the more you're going to demand. But the expectations, the shape of the yield curve reflects investors' expectations of future interest rates. Well, we'll get back to that in just a bit. But that makes sense. They're saying, yeah, it's all about the future. You are going to buy now with the thought of holding these bonds for the long term. So if you believe that inflation is going to stay low, which some people do, some people don't, you would price your bonds and pay accordingly. Maturity preference hypothesis, or sometimes called liquidity preference hypothesis. Investors tend to prefer the liquidity of short-term securities and therefore require a premium to invest in long-term securities. In other words, they're going to get their money back sooner. And then the last one is the market for debt is segmented on the basis of maturity. In other words, I need the money in a year or 5 years or 10 years. I don't need the money for 30 years. Supply and demand within each segment determines the prevailing interest rate. Well, look, these all make sense, folks. They all make sense, and they all have some merit. But what happens when the yield curve is inverted? How do we account for that? And what factors could cause an inverted yield curve to occur? What can a yield curve tell us about the future of the economy? Okay, slide 29. Since World War II, every time the yield curve has inverted, when short-term rates were higher than long-term rates, the economy has fallen into a recession. There was only one time when it didn't happen, and that was in 1966, and the economy hit zero, didn't go negative, just hit zero and then bounced back up again. So there was only one time this didn't work. The yield curve is currently mostly upward, as we saw. Shorter-term interest rates are lower than longer-term interest rates. But for about 2 years, 2006 and 7, starting in late 2005, the yield curve was inverted. Now, it wasn't a huge inversion. It was more like a little boomerang. I wish I would have saved some of those graphs. But the bond market had been predicting a recession for over 2 years. But the stock market, for the most part, didn't believe him. Go back and look at the returns in 5, 6, and 7. It was until the fall of 2008 that the officials charged with tracking the economy acknowledged, oh yeah, we're in a recession. It took over 2 years, but the bond ghouls were finally proven right. Now, why do we call bond investors ghouls? Well, there's a few different reasons for that. I don't really enjoy calling bond investors ghouls, but if you're a bond investor, you love a recession. What? Yeah, what happens in a recession? Interest rates go down. What happens to your bond prices? They go up, right? And when the economy goes charging along and inflation, people get new jobs and start bidding up the prices of wages for employers or housing or cars or whatever. Ooh, you hate inflation, so you don't like it when things are going well. Well, it's an oversimplification, but true. It's true. Bond investors tend to love it when interest rates fall. And when do interest rates fall? During a recession, right? And so we look to the yield curve. When the shorter term rates go higher than the longer term rates, we say, you know what? There's probably a recession coming, and we better batten down the hatches and get ready for it. But if for a long-term investor, right? If you know it's going to come, folks. You just don't know when. If you followed the bond ghouls over the cliff in 2006, you were 2 years too soon, right? So just be prepared emotionally and intellectually, but keep investing for the long term. Bond pricing. Okay, now here's where we actually do something that is somewhat interesting, more than the rest of bond investing, and that is bond pricing. Bonds are normally priced according to the present value of their future cash flows. Does this sound familiar? Yeah. What are we going to get in the future from cash flows? We're going to get semi-annual interest payments every 6 months, and we're going to get our principal back at the end of 10, 25, 10, 20, 30 years. Although there are other factors that always need to be considered, such as the credit worthiness of the issuer. If the issuer falls into trouble, as you saw in Chapter 9 when you took a look at the Ford bonds and the Unified School District of Poway, the price of their outstanding bonds will fall because investors will be afraid of default, and they will start dumping the bonds. They'll start selling them at any price. I don't care. I just want to get out because I don't think I'm going to get my interest payments, and who knows if I get any principal payments. So you always have to keep that in mind. But most bonds all do redeem without any problems. They pay their interest payments, so we'll leave that one to the side for now. But what's this present value of the future cash flows? Well, let's take a look on slide 31. The bond price is equal to the present value of the interest income plus the present value of the repayment principal, the principal repayment. Does this look familiar? It's the discounted cash flow model. Whereas in the stock model, we use the present value of the dividends, which we know are optional. They don't have to pay them. And we use the present value of the expected stock price, which we were just guessing at, folks, just throwing a number up or down. Where in the case of bonds, we know how much interest we're going to get. We know we're going to get our $1,000 back, assuming that we don't go, the bond issuer goes into default, right? We're just taking that off the table for now. So since bonds pay interest normally every 6 months, we really should use semi-annual compounding, but that's a lot harder to do. That's why we have spreadsheets. So when we get to the spreadsheet, well, it's a separate presentation. In the face-to-face class, we would stop and show you the spreadsheet, but you're going to go off on your own and go see the spreadsheet. However, annual and compounding is easier to compute and will give you almost the exact same answer, folks, within a couple bucks. So we're going to learn how to do it using annual compounding. But as I said, spreadsheets make life so much easier. So you're going to learn how to use the spreadsheet, okay? All right, hang on here. Let's see if I can find that present value table. Here it is. Wait, whoa, slow down. There's two of them. Yes, in chapter 6, we only used the present value of a dollar lump sum principal because we did it year by year by year. So on the right-hand side of the present value tables in chapter 10, this is the same form. This is the same table as chapter 6. The left-hand side is a new version of the present value table. So we're going to use both of these for our problems in chapter 10. All right, so let's come back to them in just a bit. All right, let's go over to slide number 32. Here's an example bond I found using FINRA. And I'll tell you, folks, it's getting harder and harder to find good bond quotes. I think you got to pay. And since I don't normally buy bonds, I'm not going out and buying a service for bonds. Fidelity lets you search for thousands of bonds, but you have to be a customer of Fidelity, and I'm not. So Bank One Corporation. This is an 8% bond that is due in 2027, price to yield 4%, or pretty darn close. And the current yield is 6%. Since 4.001% is close to 4%, and it's due in about 10 years, we're going to use 4% for 10 years. Why? Because our tables are very primitive. The tables only go on the percentage, 3, 4, 5%, and only go on the year. So we're kind of stuck. We got to use something that pertains to our table, not the other way around. Now, the spreadsheet's going to make life a whole lot easier, and you're not going to have to worry about this because once you learn how to use a spreadsheet, you're never going to do this again. So what's the formula? We take the present value of the interest income plus the present value of the repayment. So what's that? 8% bond is paying us $80, right? That's how it works. 8% bond pays us $80. And the prepayment is $1,000. Now we're going to get $80 every year, actually $40 every 6 months, but $80 every year for the next 10 years. So what is that worth to us today? Well, we could go through and do 80 times the first year, 80 times the second year, and no, it's a pain in the neck. So we go back to the present value table for a stream of payments. And I know you can't see that if you got a small screen, but you go over to 8%, and then you go down, Oh, price to yield 4%. I'm sorry, I'm going the wrong way. You go over to 4%. It's price to yield. This is where I made the same mistake my students make. It's price to yield 4%. We don't use the coupon payment. We use what it's price to yield at. You go to 4%. Oh, come on, just show me 4. It's not going to show me that. And you go down to 10 years and you see 8.111. So we could have done $80 times 0.968. $80, 0.925, $80, 0.889. We could have done it 10 times, but that's a real pain in the neck. Instead, we use the table on the left, and we only have to do one calculation. And then for the $1,000, we take the 4% and then go down 10 years for a lump sum principal, 0.676, right? You can't see that, neither can I. Because, exactly, we're only getting the $1,000 once. So that's why we use the table on the right. And if I went too fast, just stop the presentation, go back, and make sure you understand it. We take the $80 that we're going to get every year for the next 10 years, and we multiply it times the present value of a stream of payments for 4% for 10 years. And then we take the $1,000 that we're going to get once, and we use the table on the right, a single lump sum payment. So 80 times 8.111 is equal to $648.88. And the $1,000 payment has to be multiplied times 0.676, and that's $676. And it turns out that we believe the bond should be worth $1,324.88. That's the present value of those streams of future incomes. And of course, the bond was selling for $1,327.79. Now, why a little bit more? Well, because we're getting those dollars a little bit sooner than we thought. You see, the spreadsheet tells us it's worth $1,325.53. And that's probably just because they have more digits of accuracy. But for the semi-annually payments, they tell us it's worth $1,330.73. Because remember, we're getting $40 after 6 months, and then another $40 after the next 6 months. So because we're getting that money a little sooner, the present value is a little higher. Why isn't the price $1,330? Well, as we're going to see, the bond is rated triple B. So maybe investors are saying, well, it's not exactly the best credit risk, so I'm going to pay a little bit less. But it's pretty darn close. So whereas with stocks, we were simply just throwing numbers up in the air and trying to get the direction which way the wind is blowing. But because bonds are fixed, we know how much interest we're going to get, barring any default. We know we're going to get our $1,000 back, barring any default. It turns out that even in the exciting parts of bonds, they're still boring. So, so now you're going to go, right now, or not necessarily now, but you're going to go through the worksheet and work on these problems. And once you've done them a few times, they're very straightforward. Again, the hardest part is really understanding what you're doing. You're taking a stream of interest payments, bringing it back to the present. What is it worth to us today? That principal repayment, whenever we get it, 5, 10, 20, 30 years, bringing it back to what it's worth today. And you do the calculations, you get this number. What does it mean? It means that's what we should pay for the bond. And it turns out that it's pretty darn close to what it's selling for. Bonds are boring. Bonds are predictable. Bonds are stodgy. Bonds are reliable. Yes, so go ahead and do worksheets number 1 and 2, and then do the assignment, and it's going to be exactly the same as on the exam. Cool. All right. Reinvestment risk. What is this? All right, now for our last few slides, we're going to go through some things that, again, for most of us, unless you really do want to buy individual bonds, are not that important, but it's important to understand, especially if you're going to become a stockbroker or a financial representative and you're going to have very high net worth clients who want to have a portfolio of bonds. Reinvestment risk. This is the uncertainty about the future value of an investor bond's investments that result from the need to reinvest bond interest payments and redemptions, principal repayments, at yields not known in advance. Huh? In other words, we're getting a great big interest rate now, right? Actually, no, we're not, but I'm just saying, say you have a bond that's paying a great interest rate. Well, you're getting your interest payments, you're getting your principal repayment, but you don't know what's going to happen. If interest rates fall, you're so excited, right? Because your bond price has gone up, but now the interest that you get and the principal, when they pay it back, you have to invest at a lower interest rate. But if interest rates rise, people all freak out. Whoa, 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 my bond price is going down. My bond price is going down. But the interest payments you're getting and the principal repayments you're getting, you're now going to reinvest in bonds that are paying higher interest rates. This is why, as we said about 10 slides or so ago, don't freak out if interest rates go up, you bond investors. Because that money that's coming in from interest payments and from principal repayments is going to be reinvested at higher interest rates. Isn't that what you want? Yes, so that's just like in stocks, we have to take a long-term perspective. Yes, slide number 34, duration. Well, this is a fancy name for the measurement that we use to measure the bond price's sensitivity to changes in interest rates and bond yields. So we said that the farther out you go, right, exactly, the more your bond is going to be affected by changes in interest rates. So the idea is you want to capture that price risk, but also the reinvestment risk. Now, we're not going to learn how to do this, folks, because it's normally done by pension fund managers, mutual fund managers who have, billions of dollars to invest. But it's not that difficult a calculation, plus it's readily available. In general, the longer a bond's maturity, the longer its duration, and the higher a bond's nominal rate and yield to maturity, the shorter the duration. You're going to see wild swings in your price if you have a long bond out there. But if that nominal rate is quite high and the yield to maturity is quite high, then hey, what are you worried about? You're already doing okay. Right, and that's duration, and we're not going to do that. And then it gets silly. It gets duration and immunization, right? This is something we don't use this, but investors who have a specified time horizon can use bond immunization. Isn't that a great name? As if it's like a virus or something like that, to increase the probability of successfully achieving their desired goal. Well, the idea is to keep the average duration of your bond investments equal to your time horizon. So say you need the money in 5 years. You're going to try to keep your bonds at a duration of 5 years. Well, if for some reason this bond's duration is now 3 years or 8 years, you're going to want to sell that bond and then you buy a bond that has a duration of 5 years. So it requires constant rebalancing of your bond portfolio, since durations of bonds change, if interest rates change and bonds get closer to maturity. Who's going to do that? People who have billions of dollars. And if you're the mutual fund manager of an intermediate term bond fund, you've told your investors that, we have a 3 to 4 to 5 year time horizon. So your job is to make sure those bonds that are in that portfolio have a duration of 3, 4, 5 years. Likewise, if it's a long-term or short-term bond fund. So it's something we should be aware of, and as the gurus with our family and friends, but it's not something that normally we're going to be affected by. Bond investment strategies. Okay, we're coming down the home stretch here, folks. In general, there are 3 ways to make money with bonds. The income strategy, you purchase the bonds simply for the interest income that they produce. The capital gain strategy, where you're speculating that interest rates will fall or rise. You're going to bail if you think they're going to rise, jump in when you think they're going to fall. And then total return, where you purchase bonds for both the income and the possibility of capital gains. So which one of these would be the easiest to implement? Obviously, that's the income. You're just buying them for the interest and you don't care what happens to the price. The capital gains is the hardest because you're trying to determine when interest rates are falling, and that's very difficult to do. There are people who are paid tremendous sums of money to incorrectly do it. Can you imagine if they actually could do it? And then a total return is obviously a combination of the two. And you may have heard of the PIMCO Total Return Bond Fund. At one time, it was the world's for a few years. I don't think it isn't anymore, but it was the world's largest mutual fund, and that was the first time a bond fund was ever the world's largest mutual fund. It was run by a gentleman by the name of Bill Gross, who's brilliant and really a lot of fun to listen to. He's very flamboyant. He's not afraid to speak his mind, and he used to work for a company called PIMCO. He doesn't work there anymore, but he's still in the business. He's now working for Janus. But look him up, Bill Gross Bonds, and you'll see his comments. He makes them freely available to people, and he ran the Total Return Fund and did a phenomenal job, folks. Really did a great job. I haven't followed him lately, but I used to go to the PIMCO's website, used to have his letters and his writings, and you didn't have to be an investor in PIMCO, and he's a great guy. So check him out. Yeah. I'm not saying you should invest in his mutual funds or anything. I just think, again, we looked at some of the all-stars of investing, and I always believe that if you want to learn how to do something well, look at the people who are doing a very good job of it and see if you could mimic them or steal from them. And if you can't, then you invest with them. Slide number 37, bond laddering. What is laddering? Well, it's just a fancy word for diversification. What you do is you buy bonds with staggering maturities, hence the ladder. Some are short term, some are intermediate term, some are long term. Again, this is very popular with people who have considerable sums of money to invest, high net worth individuals, or pension fund, bond fund managers, insurance companies. So what are the advantages and disadvantages of this strategy? Well, it gives you some diversification. But the disadvantage is it gives you some diversification, right? When we get to chapter 11, we're going to, which is pretty soon, we're going to try to wrap everything together and take a nice hard look at diversification and find that it's never going to make us really, really excited about our investments. But at the same time, it's never going to make us really, really sad about our investments, except for those brief periods of time when both, stocks and bonds scream and holler and do really well, or sadly fall. When's a good time to ladder? Well, when you really don't know what's going on in the future, so you want to be well diversified. When it's not a good time, if you really feel that interest rates are going to fall precipitously or rise precipitously, then you would not want to be in a ladder because you're not going to be able to take advantage of the rise or fall. But can anyone reliably determine what's going to happen with interest rates? No, so I like diversification. Slide number 38. Here is a ladder, a bond ladder, as of April 12th, 2017. And what we see is that short-term interest rates, yes, they've come up quite a bit, but from 0.1 to 0.7, I mean, it's a huge jump in percentage-wise, but it ain't paying nothing. And then the 5-year Treasury, 1.8, the 10-year Treasury, 2.28. It was up to 2.49 just a little while ago, but it's backed off some. And then, as we said, the 10-year corporate, 3.18. So that's a fairly tight spread. You're not getting paid a whole lot more to take on the risk of that A-rated corporation. A-rated corporation is not going to go into default, is it? I don't think so. But look at that. Under 3% for a 30-year Treasury bond. I don't know, folks. I just can't get excited about something like that. I'd much rather get 3% from a stock. And there are lots of stocks that are paying 3%. Now, what's the difference, right? The United States government will pay its debts and you'll get your money back, whereas the stock could become worthless. But you diversify, you buy high quality stocks paying, dividends for the last 20, 30, 80, 100 years, raising those dividends the best they can. And yes, we're going to go through 1 or 2 or 3 recessions in your investing career, but you decide. Some people I love bonds. I can sleep well at night. I want to eat well. And so far, so good. If it all falls into the porcelain oasis, then it really doesn't matter, right? Because I'll tell you this, folks. I don't know if I told you already, but failure is not an option. It really isn't. If the stock market falls and stays down, if the economy really, really tanks, then the bonds are eventually going to fall too. Because how do the companies pay for their interest payments? Right, through their earnings. And if the stocks are not responding, if they're not coming back, that means the earnings and the companies are not coming back. So eventually they're going to default. And if that happens, the tax bases for the local and state and federal governments are going to fall. And so the bonds are all going to fall. Failure is not an option. I know I sound like an advertisement, but it's the truth. And so when people talk about the stock market failing, I say, well, yeah, it's going to happen. You're going to live through it. But if it doesn't come back, then the bonds are going to fail too. And yeah, real estate's going to be. And we don't want to think about that. There's no food at the Vons. There's no gas at the Chevron station. No close at the Gap. The cell phones aren't working. SDG&E is not pumping out electricity. And the schools and the hospitals and the banks and the fire departments are all shuttered. And the trash isn't being picked up and the sewer system back. Your stock and bond investments are going to be the last things you're going to be worrying about. I know. I try to be optimistic, folks. This country is so fundamentally strong it can survive its leaders. Louis Rukeyser said that many years ago, and he was a brilliant man, but he's dead now. And so we'll see. We'll see. Slide number 39. We are finished with bonds. Thank you for your excellent effort and attention and for listening to my rants and ravings. We are now going to spend a little bit of time, folks, just a little bit of time, on preferred stocks and convertible securities. Remember back in chapter 1, hybrid securities? They're not really that important. You need to know what they are, some of the characteristics about them, but you are probably not going to invest in them. Not too many people do, but you need to know them. And then in chapter 11, we're going to go and tie together the entire semester so far. We're going to go back to the very beginning and wrap it all up. And we'll be done. Well, not really, because once we're finished with chapter 11, we then have to do some odds and ends that you really need to know, if only to not get involved with them. Options, futures, shorting, margining. And then we'll spend a little bit of time looking at some alternative investments that may pique your interest, may not. See you in our next chapter on preferred stocks and convertible securities.